What's up, guys? You can see the SPY is currently at about 377, mostly sideways today, so not a great day. The report is supposed to be released at 2 p.m. So be ready. AERC, what's running right now? Carol's going to be here as well. Hello, thanks for the live. What's up, Option Formers? Good morning, man. Or good evening. I guess it's evening time for most people. I mean, it's 12:30 here in Texas, but 2%? Nah, man, they're not going to do 2%. My guess is 0.75% rate hike is what I'm expecting. I think the market will probably react positively to that. Maybe not, though. Let me know. Do you guys think the market will go up or down from this rate hike? And at what? I asked this question on Twitter, and we got a bunch of votes on Twitter, like 100 plus votes, or maybe it was like 80 plus. And most people think that the best rate hike they could give us is 75 basis points, slightly winner. The other one is 0.5%, so 50 basis points is the other one. Now, again, let me know what you guys think they're going to do, mixed with what you guys think is the best potential, decision that they can make in this situation. 0.75 for sure. I think 0.75 will be on par with expectations. And so, yeah. 0.5 will be on par with expectations. And so with that, I think we'll probably see good action, but maybe not. I think there's also a chance that we're just going to crash regardless of anything, I think there's a chance that we're just going to drop regardless for all of them. Bitcoin down to 20K again. Tesla currently sitting at 684. Amazon at 106. I think a lot of stuff is on discount, and I think a lot of people are waiting to buy stuff for this this decision here. But again, let me know what you guys are watching right now. SPY popping back up a little bit. The Q is actually a little bit stronger than the SPY today, so Q and tech is doing a little bit better. 75 is what the futures say. 0.75 seems reasonable. That's the perceived max pain for today. Yeah, for sure. And I think it's priced in a little bit. Again, I think if we're on par with expectations, we're going to get the best possible outcome. I think if we're much lower than expected, people are going to be pessimistic because they think it's not going to do as much for inflation as we initially wanted. If it's too high, I mean, if it's 1%, then people are going to say it's an overreaction to it. And so I think the best possible outcome in this situation would be 75 basis points. I think that's the most reasonable, and I think that's on par with expectations, which is the best thing to do in this situation. But again, I really don't know. We'll have to wait and see. Let me know what you guys think. All right. All right. Huh? Yeah. Nah, that can't be good. Carol just put a cracker with cheese. What is that? What kind of meat is that? It's like genoma. Salami. She put a piece of a cracker mixed with cheese, mixed with salami, mixed with the grape on it. Here. Good or bad?
Put it on there. Look, you gotta try
grape? It. No, I'm not eating that, dude. No way, man. Dude, I'm not.
You gotta try it.
Here, look. I'm not trying that. Yeah, I ain't trying that. Oh, yeah, I don't know if I'm gonna monetize yet. We'll see. I mean, I guess I could. Yeah, bro, she put a grape, a cracker, a piece of salami on it, and some cheese. All at once.
See?
It's too much.
Savory.
Yeah, hey, option knows then. I'm wrong there, I guess. That's okay.
You can at least try
the
it.
E-mini will skyrocket once the news comes out. Yeah, for sure. I mean, it depends on what the rate hike is going to be. And we're going to read the entire report as it comes out. I also post the link if anybody wants to find it. So yeah, baby, when you look at these FOMC results, specifically the FOMC meeting that happens every 6 weeks, it drops at 2. They release these PDF files basically on the federalreserve.gov website, and so it'll update there. This one will come in here.
Okay.
And there's also going to be a press conference for it.
Doing your mic.
All right, guys, we're back. Yeah, I'm not eating that. Just not touching that today. Look, I'm gonna unban Ann. So Ann, if you're watching, I'm gonna unban you. Okay, I think. Should I? I think I probably should, right?
Yeah, that's fine.
I really don't like banning people, bro. As much as, look,
Yeah,
there
I
she
don't
is.
want you to.
All right, look, I unbanned her. I just don't like unbanning people, but like, it's all right.
And I don't want my presence here to like cause drama. I want to learn stuff.
I agree.
Just like everyone else does.
Yeah, she's just learning, so I think it's actually more educational with you here, to be honest, because you're learning. But I grabbed some short-dated oil puts for the funsies. Hey, good luck, option. Hope you make some money, bro.
On the sweet and savory issue, I agree with the option farmers. I like my tuna salad with like walnuts and like craisins and grapes in it. So,
Yeah.
John doesn't.
Nah.
Cheese and shrimp. I'm sure it would be pretty good. I like shrimp and I like cheese. So when do they usually release it right on
It's at 2
time?
p.m. Yeah, it's at 2 p.m. And it'll show up at the FOMC meeting section here, so you can click on Berserker. Just had breakfast for lunch today, bro. I had Brenner yesterday, where I had breakfast for dinner. I had some bacon, or no, sausage, egg, and cheese flyettes. How do you say it? How do you pronounce that? I'm terrible at pronouncing it. And then toaster strudels. All right, guys. SPY move it up. We got about 25, 30 minutes. Hey. Hey, what's up, DS? So usually when they post these Fed meetings, they post them to the site. Is it just a link to the YouTube video? Can I just watch it on YouTube, or should I? I usually watch it on the site, but I can't remember how they did it last time, or how they usually do it. Yeah, we'll see, man. Russell says, hopefully the rate hike has been priced in already. I'd hate to see the market collapse. Yeah, I'm hoping so as well. Like I said, that's why I think 75 basis points is right on par with expectation, and thus we're going to have the least amount of reaction, which I think is good right now. Again, if it's too low, then people are going to say they're still going to be worried about inflation. If it's too high, then they're going to say it's an overreaction. And so kind of like Goldilocks, I think 75 basis points, because that's on par with the latest estimates, is probably the best reaction we can have right now. Or probably the best decision they can make. Well, yeah, there already is a high level of concern. Yeah. But I think that's what they're setting our expectations on. Some people still haven't reacted to recent sell-off. VIX never spiked hard. Yeah, we'll see, man. It'll be a fun day. We'll see what happens. Yeah, it should be fun, man. I lost today. Yesterday I made money all week. The day before that I made money. This week I'm down 2 days, but I'm down like $50 right now today. And yesterday I lost like 60. And so, pretty small day, and we'll come back from it. If you look at the markets, there's pretty tough days all around. SPY, Q, both kind of rough to trade. My young cousin's still hodling NFTs. I don't think the market will drop too much. I hope not, man. We'll see. AERC running. Yeah. AERC up to $21 a share. Absolute craziness too. Man, that is kind of crazy. That's a huge move. SPY sideways, Q sideways. SPY slightly down, Q slightly. And Q is perfectly sideways. SPY is slight down, but sideways trend. AERC ramping up big. Redbox reclaiming view up, is it really? Yeah, Redbox back over 11s. Hey, we'll see if it spikes. Certainly possible that it does. Kind of got the U-shaped breakout pattern. Redbox had a good day today too. It's still over 11. That's kind of what we want to see. So who's beeping my phone? Here, just save the grapes for me. All right, Redbox starting to creep back up. Q is still sideways. SPY is still sideways. We got about 25 minutes left until this decision, and so it should be an interesting day regarding this decision. We'll see. Where did the Discord go? There it is. Huh? No. I don't ever use this monitor. It just kind of sits there. I don't know what to do with it. This one's curved, and so it's a little bit cooler. But yeah, SPY at 377s. Here's the market over the last few weeks. So market was mostly sideways up until about a week ago. You know, a little bit of, yeah, about a week ago. You know, a week ago on the 9th is when the market started to turn to the downside, leading up until this FOMC meeting is what this is. And so basically people are scared. They also left out they put some statements out regarding their intentions for this Fed meeting that I don't think the market reacted necessarily favorable to. And with that, people got scared, and you know, you can see the market's all the way down to 370s for the SPY, 280s for the Q. And so, you know, I think $400 should be like a goal level to reach again. I think it's a big psychological level, but I don't know. You know, I don't know. I hope whatever happens today, I think the best outcome would be on par with expectations. Too much, people will complain. Too little, people will get scared of inflation still, or still be scared of inflation. So with that, I just think the best possible outcome is on par with expectations. I think that's going to get the smallest reaction, and I just don't want it to react negatively to this, you know.
Are there any predictions about what's...
Yeah, what do you guys think is going to happen for the Fed meeting? What do you guys think is going to happen?
Predictions on
yeah.
meeting.
What do you think? How much do you think the Feds will raise rates? Is what we need to ask. How much do you guys? I'm gonna do a poll right now.
75 points.
I'm going to do a poll right now, and so vote a poll. Let me know what you guys think. There is 0.5, always an expectation. 0.75 is also there. 1 is what a lot of people are scared of. And then I'm just going to put something else. It's in chat. Vote on the poll right now, guys. Let me know. Let me know. Should be a fun time. We got about 22 minutes.
You want to put it on your headphones here?
You can. $75 basis points, 0.75. Yeah. If they're doing 75, they are stressed. Don't fight the Fed. 50. Yeah, we'll see. SPY currently again at 377.30s. We've had a sideways few days leading into this Fed decision. Most of it, I think we are baked in to a certain extent, because I think this is people baking into the decision, potentially. And so I think, we got this drop on, again, the 8th and 9th about a week ago. And I think this is everybody kind of getting baked into the Fed decision today is what is what I think is going on. Now, who knows if that actually is what's going on, who knows if that's what they're doing, or who knows if we'll react more. I guess it all depends on what they ultimately decide. 0.75% rate hike is giant. Yeah, for sure. But that's expectations right now. Again, I mean, like I said, they could do less, but people are still going to fear inflation in that situation. They can do more, and people are going to say it's an overreaction. And so I think 75 basis points, because that's right around expectations, is probably the best bet for what, the best case scenario in the situation. Obviously, we're not in good area here if the Fed's having to raise rates this much. But we already know that the inflation's already bad. Inflation's already bad. And I think allowing them to try to curve it is fine. I don't know. I mean, it's not fine, but it's not. I just don't want to see the market sell off, I guess is what I'm trying to say. I don't want to see the market sell off more. I think 50 basis points is already priced into the market, so 75 won't be too shocking. But one should be done and just pull off the Band-Aid and let it adjust. Yeah, for sure. 0.75 hasn't been done since 94. Yep. Inflation's at pretty high levels, and so playing Monday morning quarterback is easy for what the Fed should be done. Market's going to crash big. The media claims 75 is the expectation as of Monday, when Friday was 50. Yeah, but I think things changed. You are being played. The market will crash big today. We'll see. Possibly. Possibly. Again, the question is, here's the question, okay? Here's the SPY over the last week. This is a pretty big drop. We dropped all the way from 415s down to 370s where we're at now. Okay, is this baked in enough for everybody? Is the real question. Like, is this enough down to stop the bleeding? Or is fear going to loom regardless of what decision they make? I mean, that's the real question. And we'll see.
Probably will, man.
What?
Just in today's, the atmosphere of today and, the uncertainty of everything.
Yeah. Twitter has some large candles movement over VWAP, S&P 500, gold, and the Dow and gold at support and threatening. Or is it already priced in? Yeah, Jerome Powell is trying his best to keep the USA out of a recession with the current 30-year mortgage at a staggering 6.5%. Actually, I mean, I don't know why mortgages are that high. That's kind of a crazy percentage. And the reason for that, the reason I think that's crazy is because I think right now is the worst possible time to buy a house. And I would think the general public understands that, now's the worst possible time to buy a house, And so why would people want to buy houses right now? I would think that, but I know real estate's gone absolutely crazy over the last few years. Prices have skyrocketed, which again, though, I think obviously makes it less appealing to purchase a home. And I would think less people are interested in that right now. But who knows? People are strange. What's going on with Twitter? Twitter got a big volume surge just now. Somebody bought something, but I don't know what. But look, as a lender, why should lenders lend with 8.6 eroding returns? We close on a house 725. I mean, why is it the worst time to buy a house? Because in my opinion, and again, I really don't know, I might just be flat out wrong. This is just my subjective opinion. But in my opinion, the housing market's in a huge bubble right now, man. Everything's ridiculously high, not sustainable prices, in my opinion, And so, yeah, I just don't like the housing market right now. I think the prices are too high. If I was going to buy, I'd wait for prices to stabilize a little bit. And I think they have over the last few months, but I still think that they're pretty pretty unreasonably high. People are waiving their notice of appraisal. People are doing a lot of crazy stuff in real estate right now, and it just seems to be a bubble, in all honesty. You know, but I might be wrong. Like I said, purely subjective. I don't want you to make any decisions based off of what I'm saying. Again, purely subjective. I have no idea. The market might keep going up. The real estate market might keep going up. No idea, man. You know, I always try to give people reasonable expectations. Like, I really don't know. I'm just speculating.
And look, we moved last year.
Yeah, do your thing.
And it was crazy. Yeah, I mean, we trying to find a house.
Yeah,
was hard. We had this was the place we finally bought was our third offer that had been. They had to, what was it that we gave our offer, and we were kind of going back and forth, and then something happened, and then yeah. Well, they were waiving notice. We looked at we put in offers in a bunch of houses, but again, I guess Sean, you're not strange at all, brother. Like you just became a father, you said, or you just had twins, man. So you need a house, bro. I'm not saying don't buy a house, brother. I'm really not. Like I said, I think in the end you'll be fine. Yeah, there's always going to be a housing market, I believe. Even if it's,
buying a house is good regardless of when you do it, No.
And if you think of in the last few years too about, just how crazy everything is, and we've had a lot of people moving and, moving to different states, and, that's going to obviously, I know it's affected the housing market here in Texas where we are, but
houses still seem cheap in Texas. Houses are cheap in Texas, man. Again, you can get a house in Texas. You can get a really nice house in Texas for like $250. Like an amazing house in Texas for $250. Sorry, I usually try to. That's not my playlist. Let me put my playlist on. But no, you can get like an amazing house in Texas for like $250. You spend $250 in Cali or
you can rent a shack.
Yeah, you can get this little shack. And so it's just kind of.
I wouldn't have that. I'm just gonna...
Well, no, that's the reality of it for sure. Housing market will stabilize. We, the people, choose our price to sell or buy. We control the prices. And why would you sell your home into a collapse? Where will you stay? Yeah, I feel you. I get it.
Yeah, there's always going to be.
Yeah, look, when Pawn says when a house that cost $200K 3 years ago is nearly $450,000 now, where it's had over 100% double in value over a 3-year period, there might be a bubble. And now the bubble now is different from 2008. 2008 was just irresponsible lending. That's all. That 2008 boils down to irresponsible lending, and that's it basically. Now the stock market, traders and investors and brokers did a lot of dumb stuff back in 2008 as well, but like it was mostly just from irresponsible lending. Now they built laws around what they did in 2008, so now it's not that at all. No, JB, I don't like saying. I could flex this house if I wanted to. I'm not. I don't need to. I like privacy, man. I promise you, I could, if I really wanted to. I could flex my house easily. I could use it for marketing. I could act like I was a sleazy penny stock guru that turned $1,000 into $1 million or whatever they say. But then I'd probably sleep bad at night. So I'd rather just not show people inside my home, have weird people showing up at my house, Oh, 250 in Texas gets you how many square feet? Oh, okay, got you.
Probably, but it depends on the area.
Depends on where you are.
So like
250 can get you like at least like a 2,500 square foot house at least in a nice area.
Well, I was thinking you could get more of that in the country, but like if you're gonna try to be near or around one of the cities or in the suburb of like wherever, it's gonna be more. Just because it's more crowded, but the more you go out into country, you could get nicer houses and sometimes even land.
Yeah. My man said affinity fraud is a felony in the US. I get it, bro. Listen, my channel's called Beginner Trading, bro. You really think I'm out here claiming to be an expert, dude? You know, I'd have the easiest case ever if they tried to arrest me for that. You know, I would splice together every day of streaming being like, hey, I have no idea what anything we're going to do. Don't copy me. Don't send me. You know, it would be super easy.
Same pop culture. It's around 1 or, right?
What?
It's around 1 our time. 2, someone asked what time the...
Oh, it's at 2 p.m. Eastern Standard Time.
Yeah.
So it's in 10 minutes. Hey, thank you, Chocolate. Yeah, for sure, man. I try, bro. I try. Yeah, it's hot in Texas right now.
Yeah. What is it today?
I think it's 105.
Yeah.
All right, guys, 9 minutes. Market turning, pre-meeting. Waiting for the Fed meeting. Yeah, SPY dropping 0.75 on increase. Yeah, I think so too, man. I think that's probably what we're gonna get. I would hope that's what we get. What's up, Lane? Homes around Fort Worth and Burlington, Texas. Prices are going for 280 to from 280 to 300 square foot. Damn.
Yeah, everything's going up.
Everything's super high, bro. That's why I think there's a real estate bubble right now, man. I think the real estate market will correct. Yeah, I just think it's too high. Again, as a real estate agent and as somebody that purchased a house in the last few years, it's not like I'm biased because, you know, like we actually just purchased a house at the worst possible time. And so I understand, like, it's not confirmation bias is what I mean. Like, it's definitely not confirmation bias because if anything, me believing this, if what I say is true, it hurts me, you know, it hurts Carol. It hurts all of us, you know what I mean? And so, but with that said, though, after seeing it and people waiving their notice of appraisal and waiving all these different things in Texas to where they're not even getting appraisals on the home to make sure it's worth what they're paying for it. And so they're just throwing out big offers. There's 6, 7, 8 offers competing with each other at a time. Prices have raised over 100% over the last 3-4 years. In my opinion, I think that's bubble-like. But again, I might be wrong. I don't know. Maybe the real estate market just runs for the next 5. It could.
I mean,
You know?
I feel like the time we're in right now is not.
Bet you charge. Hold on. Wait. Bet you charge for Discord, bro. I don't charge for anything, dude. I literally sell nothing, sir. I literally sell nothing. I don't sell a course. He's just a troll, I think. I don't sell a course. I don't sell a service. I don't claim to be an expert. I don't act like a guru. I don't do anything. Every content that we put out is free, including our Discord. I don't know how many people I've had come up to me being like, yo, partner with me and I'll charge for Discord and you'll get a cut of it. Partner with me and I'll put a course on your Discord and you'll get a cut of it. Hey, help me build some type of, course and we can split the profit. And I'm always just kind of like, no, not today, sir. I don't think 0.75 will make the market rip. I think 0.75 is how we have the most even reaction to the Fed rate hike. I think 0.75 will have the most even reaction to it. With that, I think that's the best case scenario here because I think if we put it too low, people are going to still worry about inflation. If we put it too high, people are going to say it's an overreaction and we're going to drop regardless of either one of those. And so I think the best thing that we can hope for is on par with expectations so we get kind of a flat reaction because I think the market has already dropped so much. If we look at the SPY here over the last, like I said, the last week or so, we've dropped a lot. We've dropped from like 4 or something down to, let me put up the week chart, maybe a 15-day chart. We've dropped a lot. And so I'm hoping that this last week's movement is baked in already, but who knows?
Okay, Ronnie.
Yeah. No, my mom. I was laughing at this guy. Discord is free. The question though is, who is John the Tyrannical? Bro, I am John the Tyrannical. Dude.
That was a perfect day for that name change.
I'm John the Tyrannical, bro. Come on now.
Oh, goodness.
Hey, don't feed the trolls, guys. It's all good.
Yeah. All right.
Bro, I'm loving life, dude. You know, I'm over here eating grapes, bro. I don't know, guys. Let's see what the reaction is like. We got 6 minutes. 6 minutes into the reaction here. Yeah, you made 128 million, Ronnie, bro. I made 70 billion yesterday. Okay. Ugh. You know.
Well, that was that.
Right. Bitcoin rip it up. Is Bitcoin rip it up, dude? I hope it does, bro. It's got to rip up. Been doing well. It's good for me. All right, markets rip it up at 281. And so I think we're just following the market to a certain extent with crypto, right? I know the U.S. government owns like 5 billion Bitcoin. And we're doing great. Look at this move. Bitcoin is almost flat on the day, which is great.
Oh, wow.
Bitcoin is up. Look. That's Bitcoin right now. Hey, thank you, James. You as well, brother.
Yeah, it's good to see you, James. When I see you. But,
yeah. All right, guys. Still waiting here for the FOMC meeting to start. We got 4 minutes here. 4 minutes. Oh, wait, did they change it to 2:30 Eastern? Did they? They do say 2:30. Did they change it? All right, guys. So yeah, SPY is at 377.75. So market's starting to reel back up here. Hopefully it holds. 2:30 is the press conference with Powell, John. Okay, got you. All right, so let's see when they drop this. Three minutes, guys. SPY ramping up in anticipation of it. No. Right, yeah, the rate comes out at 2. The press conference is at 2:30 is what it is. Yeah, we get the number at 2 is what it is. And if you guys want the website, you get the number at, so y'all can read it with me. Here's the link. This is where the number is going to be released here. Hey, have fun with that, Walter. Yeah, there's the link if you guys want to see where they're going to release the number to. Last time the rumored 75 and delivered 50, but was small odds on 75. Oh no, so the numbers are going to be released here at 2, right here, right there at 2. So that's where the numbers are going to be released, and then the Jay Powell meeting is what we're going to be reacting to. 2 minutes, guys. 2 minutes. A little bit less than 2 minutes now, really. Is this a bull trap, guys? Let me know. Market will crash today. I do have one question for you, John. Has your daughter ever asked for a rematch on the wiffle ball strikeout bet yet? No, she has not. You know, after I hit the homer on her, you know, I think she knows. Maddie's actually good at baseball now, though. Her and I will go throw the ball, dude, and I swear, I've got to at least be throwing this ball to her like at least 60 miles an hour, 70 miles an hour to her. You know?
Yeah,
She's got good. This market has 12 to 18 months left to get through before it even makes sea sunlight. Yep. Bull trap, certainly possible. All right, guys, less than a minute before these numbers come out. They should be out in roughly 40 seconds, guys. 40 seconds before the numbers come out, and we're going to see how the market reacts. We got the SPY on the right, the Q on the left. See how the market reacts. Market's pushing up. SPY is up 378.60s. 20 seconds roughly, or 10 seconds really. No matter where the SPY goes, we'll still have low float runners every week to bank on. Yeah, for sure. SPY's up to 378s. All right, here's the decision, guys. I'm just going to go ahead and read this as soon as it comes out. All right, let's see what the decision is. No drop right here. All right, getting some drops initially after this happens. Still waiting for the report to release. Let me check Benzinga. See if Benzinga will have it. Big upward reaction to this, guys. Big upward reaction. 75 basis points. 75 basis points. Big upward move. It's at 283s. 283s. Okay, here it is. All right, so we're going to go ahead and read this, guys. Wait, it moved. Why? Okay, let me refresh this. There we go. Okay. Overall economic activity appears to have picked up after edging down in the first quarter. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances. The invasion of Ukraine committee seeks to achieve maximum employment inflation at the rate of 2% over the long run. In support of these goals, the committee decided to raise the target range for the Federal Reserve to 1 to 1.5 to 1.75%. And so it anticipates that ongoing increases in the target range will be appropriate. In addition, the committee will continue reducing its holdings of Treasury securities and agencies, debt and agency mortgage-backed securities as described in the plans for reducing the size of the Fed Reserve's balance sheet that were issued in May. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance on monetary policy, the committee will continue to monitor the implications of oncoming information for the economic outlook, and the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wider range of information, including readings on public health, labor market conditions, inflation and pressures and inflation expectations, and financial and international developments. Voting on the monetary policy were Jerome Powell, Chair, John C. Williams, Vice Chair, Michelle W. Bowman, and a few other people. The Board of Governors of the Fed Reserve voted unanimously to raise the interest rate paid on reserve balances to 1.65% effective June 16th. As part of its policy decision, the Fed Open Market Committee voted to authorize direct and open market desk at the Fed Reserve Bank of New York until instructed otherwise to execute transactions in the system open market account in accordance with the following domestic policy directives. Undertake open market operations as necessary to maintain the Fed fund rate and target range of 1.5% to 1.75%. Conduct overnight repurchase agreement operations with minimum bid rate of 1.75% with an aggregate operation limit of $500 billion. Yeah, so look at the drop in the market here. So right now we're mostly flat from this decision so far. All right, way up. In related action, the Board of Governors of the Fed Reserve System voted unanimously to approve a 0.75 percentage point increase in the primary credit rate to 1.75% effective June 16th. In taking this action, the board approved the request to establish the rate submitted by the Board of Directors. So yeah, SPY at 375, or SPY at 376.80s. Q is at 279.90s. Yeah, we'll see. Yeah, so we'll see, guys.
Yeah.
Fed see unemployment at 3.7% at the end of 22, 3.9% for 2023. Say strongly committed to bring inflation down to 2%. Yeah, no worries, eBay. There you go, guys. We're gonna drop all the news reported here. Fed officials see inflation of 5.2% at the end of 22, 2.6% for 2023. Housing market is at its worst since 2008. Man, what have I been saying, man? Ooh, when you're right, you're right. All right, see what the press conference says. All right, so market's red. All right, down to 375.20s for the SPY, 278.60s for the Q. Yes, the VIX is halted for me as well. Looks like a volatility trading halt from it moving up too big of a percentage is what I'm assuming this is. It doesn't say halted either. It says NA in terms of bid and ask. Market's still dropping. SPY down to 374s. FOMC voted 10-1 for Fed fund rate action. All right, well, market's bleeding. It looks like the VIX is back. VIX is now down to 31.17. All right, SPY just went red on the day. SPY's down to 373s. All right, we got about 23 minutes before Powell speaks. Yeah, big movement. SPY bouncing up a little bit, Q bouncing up a little bit as well. SPY up to 375.30s here. That's what people do, you know. All right, so yeah, Fed raising the rates 0.75%, 75 basis points. Steepest since 94. Market's starting to rebound a little bit, though. It's at 374.80. I mean, this drop isn't horrible. I mean, we'll see if this is just the start of it. But this drop so far isn't terrible. I mean, are we red on the day? Sure. Are we still, or no, are we technically green on the day? Yes. So technically we are green on the day. We went up a little bit in pre-market, but we're technically green on the day as well. You can see the previous closing price on the SPY is 373.80s. So on the S&P 500, that would be 37.35 roughly. And so this level is the red to green level. So this is the level at which we go from red to green on the day on the SPY, and we're edging closer to that now. We're currently at 374.30s. That level is 373.80s. So we're pretty close. We're less than $1 away from it on the SPY. I mean, what the heck do people expect? That should have been already priced into the market. People are so fickle. I mean, we haven't really done too much. The market's actually moving up a little bit now. We're at 374.40s or 375.40. So, I mean, it's not like we haven't had destruction yet. You know, we haven't had destruction yet. All right, SPY back up. S&P 500 back up to the 3700s. SPY up to 375. Q up to 380s or 280s almost. 279 15s now. So we're starting to rebound here. We're mostly break even today, guys. We're slightly green to be specific here. We're slightly green. We're at 375s right now for the SPY. So as long as we hold this and we don't drop under that previous closing price and just dump down, you know. 0.75 increase. So bounce. Well, that's the expectations. And we're not bouncing. We're down since the decision. We were green on the day, though, is what I mean. So technically we're green on the day still, but we are down from the Fed decision. You know, Fed decision came out here. And, you know, you can see we had a pretty big drop. You know, this big candle was when the Fed decision was announced. And so we're dropping. Don't get me wrong. We're not green on the Fed announcement, but we're not green. We're not red on the day yet. We're still technically green on the day. That's what I'm saying. So let's see what the market's reaction to it is. All right, and we're back up. We're back up to 375.80s, almost 376 on the SPY, 37.60s for the S&P 500. Yeah, I mean, she's my wife, Crown, but I appreciate it. You know. All right, let's see if we hold here. Mostly sideways last 3-4 minutes. I mean, I don't think this ultimately matters that much. I think if we're going to go down, we're going to go down. And right now is relatively insignificant in the grand scheme of things if we zoom out. And so let's watch this over the next 24 hours. That's when it will really tell. And really over the next week or so is when we'll fully understand how big this affected it. Fed minutes comes out in a few weeks. That'll impact everything as well. And that might give a little bit more detail on why they made this decision. But yeah, we'll see.
This is going to have on everything.
What effect do you think this is going to have on everything?
Like the rate and like what you can guess what they might come out and say if they're
well, okay, so 75 basis points historically is a very large reaction, you know, but inflation is also really bad. And so what this shows us is that the Fed really wants to control it. And so, I mean, there's an argument for both sides. You know, like I said, it's on par with expectations. I think that's good. It's very aggressive. And so, if this does what it's supposed to, that should be good. But again, the fact that the Fed had to make this decision to be so aggressive is not a good sign as well. And so there's arguments for both, to be honest here. There's arguments for both. You know, it's a matter of subjective interpretation. And, you know, we'll see. Hopefully, I tend to be a bull in the market. I want the market to do well. You know, I want the market to do well. I don't want the market to go down. People generally suffer if the market goes down. And so I don't want the market to go down. I want the market to do well. But we'll see. This is the largest rate hike since 1994. So this is the largest rate hike in 28 years. Or no, 26 years. It's a lot. It's a long time. Y'all do me a favor, though. Hit the subscribe button if you haven't already. Hit the notification bell. We do this live every weekday morning for free. My channel, my goal of this channel is to never sell anything. I don't sell anything. I don't charge for anything. I don't claim to be an expert. I don't act like a guru. I give everything away for free without claiming to be an expert. Oh wait, yeah. So sorry, yeah, 28 years. I was right initially. For whatever reason, I was thinking 96 or yeah, 98 is what I was thinking. But yeah. All right, so the news is they're raising it by 75 basis points, right? So they raised it by 75 basis points. Again, not good. Not good, but market hasn't really been disastrous yet. And overall, we're still technically green on the day. No huge reaction yet to it. We dropped a little bit. We're back up some, so we're chopping back and forth. We went up a little bit initially. We dropped down some, and now we're bouncing back up. SPY itself is at about 37.60. So hopefully we hold over the previous closing price down there at around 374. Yeah. They did raise inflation estimates as well. VIX corrected to its level before the announcement. Yeah, so right now we're mostly flat, which I think is a great reaction to this so far. We're mostly flat, which is a great reaction to this so far. Now, again, higher rates lowers pricing. Yeah, I mean, the whole point of raising rates is to try to control inflation. And the logic of it is you raise rates so people stop buying as much. And then when people stop buying as much, in order to remain competitive, prices tend to go down in that way in order to remain competitive. Now, it doesn't always work like that. And there's certainly some crossfire with people that end up getting hurt from this. But that's the logic of the Fed system. And, it is what it is. Market's looking okay now. Market's going up 360 or 37.64 now. 376.60 on the SPY. Q's up to 280s. And so the market's doing okay. It's not doing horrible right now. In terms of votes, we got almost 400 votes. How much do you think the Fed will raise rates? 63% said 0.75. We're going to end this poll now that the Fed decision is over with. And we're going to do another poll. Are you happy with this 75 basis point hike? Oh, crap. I messed up the poll. Hold on, guys. Let me fix it. Are happy. No. Again, vote on the poll. Let me know. Are you happy? All right, SPY up. Hey, SPY's testing VWAP here. It's at 376. We're roughly break even from the announcement. The actual press conference is going to be in 13 minutes. Yeah, good, Mike. Dollar index just went green. Yeah. Doesn't the financial sector tend to do well with high rates? Too much, too late. Yeah, it's been kind of a crazy few years, though. It really has, man. All right, S&P 500 at 37.68 right now. SPY testing 377. It's almost completely flat from this announcement. So, press conference is pretty soon as well. High rates seem to be good for banks and lenders. Yeah. Again, vote on the poll. Let me know if you guys like the hike. Are you happy with the 75 basis point hike? 72% of you out of 30 people already that voted over the last minute said yes. So again, vote on the poll right now. Vote on the poll. Let me know if you like this hike or not. And I mean, we are roughly flat from this announcement here. And again, I mean, if you guys heard me talking about it prior to this, I thought 75 basis points would be, I'm not saying it's good, but it's ideal relative to the other options in this current environment. you can say, hey, the Fed shouldn't do anything, and then inflation gets even worse. Or you can say, hey, the Fed needs to do more, but then everybody else is going to deem that an overreaction. And so I think with that, this was the best thing that we could have done, and we're mostly flat from it. I think that's good so far. Hopefully the low unemployment rate will help people affected by the recession. Yeah, I mean, something I told my daughter, is that right now we're living in an age where you can truly make money from home. This isn't like 2005 where everybody's trying to sell a course on how to make money from home or a website on how to make money from home. We are truly at an age now where, regardless of what you want to do, for the most part, you can find a way to monetize your home life and make money from home. And so hopefully people understand there's lots of ways to make money. John's passive income course coming now, guys. No, I'm just joking. Redbox ramping up, guys. Yeah, look at Redbox. Over VWAP. Hey, thank you to everybody that subscribed. I see you guys. I appreciate it. Market's starting to pop back up here. SPY at 377s. Over 377s. Trying to be, at least. Q. Q currently at 280s. Tech is leading a little bit over VWAP. Relative to the SPY. Retail arbitrage, yeah. People stop getting free stimulus and unemployment benefits before. The stream is making me hungry. I'm sorry.
Sorry.
Jones.
When I came in, I was hungry, so I brought some snacks.
Carol brought me food, yeah.
Snacking ever since. It's basically lunchtime.
Yeah, it's almost.
You go grab something.
Yeah. Rivian breaking out?
Something, come eat with us.
Rivian had to have some news, right? All right. Right. I mean, listen, if VWAP fade mugs went on the same trajectory as housing, they should be worth like $1,000 a pop, man. I'll just turn them into an NFT and profit from it. That's how we'll do it. We'll just turn them into an NFT instead of actually getting a trading mug. You can get a picture of it. Boom, business idea.
Picture of the
VWAP fade mugs. A VWAP fade mug NFT. We'll call them mugs with a Z. It'll just be a picture of a coffee mug with coffee in it. I mean, you can't drink it like regular coffee, but like somehow it's worth more than regular coffee. Thus is the life of NFTs.
you gotta start somewhere.
Yeah.
Good genes are great for the
We gotta throw that comment up.
I like that.
Yeah.
Yeah, that was a good one.
Oracle? Yeah, I missed the Oracle earnings the other day, but they were good earnings. Yeah, it's bouncing up a little bit, but I think most things are just following the market right now. And so I think if you look at most large cap stocks like this, they are mostly reacting to the market. They have the same price action. They might have done other things before the announcement, but if you look at them after the announcement, they're mostly doing the same thing. Like here's Oracle, and then here's SPY. So you can see they're mostly similar. Yeah. Yeah. Yeah, financial freedom. Q was at 279s. So we're starting to reverse here. Now again, 373.80s is the previous closing price. It's the level at which we go from red to green on the day. And the S&P 500 is 37.35.48. And so we do have the previous closing price there. And yeah, we'll see what happens. Market's starting to turn. I mean, what should I do with the press conference? You know? Yeah, I can try here. Hold on. I guess the press conference is in 5 minutes. 5 minutes. Yeah, buy John's Guru course, guys. You know.
Yeah, that's how it seems like sometimes.
Yeah, that's how it is, especially in trading. I used to have this dude. I can't remember what their name was, but this dude would walk around with like a backpack, and he would have like a bunch of like fake money in it, and he would be like, "Look what I made this morning," and he would pull it out. Yeah, it's like, what is your computer, an ATM machine, bro? It was funny. All right, 5 minutes. Okay, I spelled that right. You think you're smart until you got to spell conference, you know? C-O-N-F-E-R. Yeah, I got it right. I was just making sure I got it right, you know? You're missing a chunk out of your hair in this thumbnail, so I'm trying to like hide it, but look at that.
Oh yeah. Yeah, that's all right.
That's probably good. All right, guys. Market's mostly consolidating up. Are you expecting a crash now? Where's your wad of cash, bro? I don't know. Thank you, STA. I appreciate you, man. Dow will go to 28K. So is GameStop going up after the press conference or not? I don't know. I think GameStop and AMC have been mostly following the market lately, and so I think it's relative to what the market's doing. I think if the market crashes, GameStop, AMC are going to go with it. I think if the market goes up, I think GameStop and AMC will react somewhat, at least to a certain extent, to that market activity. Dude, why does it think that these guys are like bad? Like YouTube, like it stops their messages. The guy's like, yeah, y'all hit the like button if y'all are supportive, and they're like, nope, that's out of line. We're gonna hide that comment. Don't tell me that. Don't spoil it, eBay. Easiest way to get banned in here if you spoil Jurassic Park.
Him and Matt
Okay.
gotta watch it together.
That's like my daughter.
That's
Nice thing.
their thing. So I don't even really. I watch the old ones, but. Ooh.
Whoa. Yeah, unplug my computer. There you go. All right, guys.
Do you want it down a little lower? Is that good? Yeah, the old ones were really good. I love the old ones.
Well, the old ones suck, except for the first one. Okay, I love Jurassic Park, but the old ones, nah, bro, they're all terrible, bro.
We just watched it with the kids about 3 weeks ago.
You're trying to tell me a kid can sit in a tree and not get eaten by dinosaurs and just living life in that tree, eating candy bars for like months at a time, like a freaking 12-year-old kid, bro? Look, I love Maddie. You drop her off in a jungle with dinosaurs, and I give her maybe 2 days, tops. Okay. Oh, there's Matt. My daughter's in here like, what? Dude, you know it's true, bro. Is that not true? Yep. You can't even argue. Good day, sir. All right.
Yeah, that was I feel like the best part. And my dad, I don't know if any of y'all remember in the late 90s, early 2000s, the thing about like having a piano, but then having a piano that could like play itself, where it's got like a like a box where you put in like a floppy disk type thing.
All right, hold on. Press conference in less than a minute. Less than a minute press conference.
Anyways, I'll finish it up. I remember there was a piano and it had the Jurassic Park theme, and it would play it. The theme song from the first one. I guess the theme songs for all of them.
Yeah.
That's what I read.
Yep.
Anyways. Also played Lion King.
All right, guys, we're waiting here. We're waiting. If you want the link, I mean, I'm not going to give a link. But...
It wasn't an actual piano player. It was like a box and it was like the piano was automated. So it would automatically push down the keys, but nobody was playing it. But it would play that song or whatever you put the disc in.
Yeah, I remember those. All of them do that nowadays.
Yeah, now they do.
All right, 10 seconds, guys. 10 seconds.
Anyways.
I'm not sour. I'm just messing with. My daughter came in here like, yeah, you know. All right, guys. Dude, why are they playing music? All right, guys. Here's the press conference. Top Gun was cool, bro. I like Top Gun. Freaking Goose, man. R.I.P. Q was up there, 278s. Let's see what the reaction is. All right, here we go. Turn the music off.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
Let me make sure you guys can hear it.
We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage points and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories, core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. and we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Hey, Gina.
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels. And we came to the view that we'd like to do a little more front end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range. And that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And, so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting. And that's what we did.
Steve.
Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But this 3.8%, 4% get it done because it gets the job done and breaking the back of inflation.
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're gonna find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're I think as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Neil.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Colby.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
The second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking. Ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down, and that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, and frankly, we saw last year inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take, for example, in the labor market. So you have 2 job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and you know again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, you know, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. You know, we hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place, but to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple of years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate. So we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for, such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices, but all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're of course watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit. We're responsible for watching everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, I mean, the energy prices are set by global commodity prices. And most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too, also other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in. And we can't do much about the difference between the elements that make up headline that are not in core.
Can I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Victoria.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do, because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the really critical question from the perspective of doing our job is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, and where do you see those going in the near future?
Yeah. So as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges. And again, the answer to the question, can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Hey, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack. Although I think we have, of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single family homes in the suburbs famously. And so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now and rates have moved up. We're well aware that mortgage rates have moved up a lot and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels. So thank you very much.
All right, guys. So yeah, good luck. Don't forget to hit the subscribe button if you want free trading content. We drop free content live every weekday morning right here on YouTube. We don't sell anything. We don't charge for anything. We don't claim to be experts. We just give away free content, and we're just a free resource and community for trading. So hit that subscribe button, hit the like button. We'll be back bright and early tomorrow morning. Good luck. Hope you guys in green today. And yeah, we'll see you guys next time.